It's almost an endless list of types of property management out there. You got to be real careful with the one you pick. They have to be a really, really good fit. And I think that's one thing that we did really well, was selecting the right property manager for the property we have.
Hello, and thank you for joining us today on the Gentle Art of Crushing It show, where we focus on learning and sharing with our listeners all there is to know about how to create success in our lives. This show stands on the shoulders of giants. Our mission is to empower and inspire our listeners to create the life of their dreams whilst having a blast in the process. Let's celebrate life together. Welcome to the show.
All right. Welcome back to the Gentle Art of Crushing It podcast, Passive Investing Edition. My name is Randy Smith, and I'll be your host today. And I'm really excited to have a friend, Colby Fryar, with us today. Colby is the principal at Mountain Bridge Capital. He's been in real estate since 2013, and he owns and operates properties in Tucson, Huntsville, Alabama, Montgomery, Alabama, Albuquerque, and Las Cruces. So, Colby, welcome to the show. I'm really excited about digging in.
Thank you so much, Randy. Really appreciate the opportunity.
Awesome. Well, yeah, let's go ahead and jump in. Can you tell the audience a little bit about yourself and how you found yourself in this space?
Yeah, so my background's in civil engineering. Worked as a civil engineer for over 20 years. And along about 2013, we started investing in some single-family properties, my wife and I. My wife was actually more interested at that point. She was driving around neighborhoods, and that's what got me kind of hooked on it. And then we ended up buying a couple of properties after, the big meltdown, 2015-ish. 2013 was our first one, then 2015. And then, as you know, everything just kind of dried up. And we were like, well, what are we going to do? And then so we started looking out of state then, and ended up buying a couple of turnkey properties. I know there's no such thing as turnkey, but in Alabama, and they were not turnkey by far. They were anything but turnkey. But it did give us a good start in the market there. We learned the market. We got our property manager. We got our team built, which was really cool. And from there, we did a couple of the BRRRR strategy: buy, rehab, refinance, and then repeat. And we did that on 2 properties, got a couple of good value adds there.
Wait, and where was that, Colby?
Huntsville, and all were in Huntsville, actually. We did buy one of the turnkeys was in Montgomery, Alabama.
Got it.
And so then it seemed like it was getting hard to find deals around 2020-ish again. And so we decided at that point to start looking at multifamily. I love the thought of more units, and I loved, just kind of imagining the cash flow that could be obtained and underwriting those deals and learning about them. And so I was really fascinated, but really didn't jump in till kind of mid 2020, and then got our first multifamily property in Albuquerque, a 12 unit. Then right after that, 123 units in Las Cruces, New Mexico. It was a portfolio deal. And subsequent to that, not much happened for a while, and we just closed a smaller property in Albuquerque, an 8 unit. And we've been focusing on Tucson primarily, but also still continuing to look in New Mexico and Texas and all over the place. So it's been a really cool journey and real exciting. And
are you interested in real estate investing but don't know where to get started, or think you don't have the time or money? Are you stuck in your W-2 because the golden handcuffs make it hard to walk away? If this sounds like you, check out impactequity.net and schedule some time to talk with the founder, Randy Smith. Randy went from massive income to leaving his W-2 through passive income, and he can help you do the same. www.impactequity.net.
It's interesting. I didn't realize how similar our stories were. I'm not a civil engineer, of course, but I started with turnkey in Kansas City and then moved to BRRRR in Atlanta, and kind of found literally in 2020, kind of hit that same spot that you did, where I was having a hard time finding properties to do that same thing right around COVID, right?
Right. That's right at the time.
Yeah. And then, interestingly enough, it sounds like at that time when we were both at that same spot, oddly enough, we didn't know each other. You went into active multifamily investing, and I went into passive multifamily investing. So I'm curious. Like, we've had all kinds of shows about people talking about, I'll call it passive turnkey investing, which is just, it's an oxymoron. It does not exist in my experience, anyways, and it sounds like yours as well. But tell me why you decided to go down the active path versus the passive, because I ended up looking at a 12 unit in Atlanta as well. And I ended up backing away from it because, quite frankly, it scared the crap out of me. It just seemed like too much for me. So talk about that if you can a little bit. I'm curious about jumping into active.
Yeah, man, that's a good point. Sometimes I look back and think maybe I should have gone the more passive route, but because it's definitely a huge challenge. But I've always been so fascinated with the active side and being a part of the asset management. And I think with the difference might be in my background as a civil engineer, running construction projects and big projects and project management. I just kind of gravitated to that. And so that's always been the excitement for me, waking up every morning, trying to find a deal, get it under contract, go through the negotiations, and then do the asset management, make the thing work. And so I think that's kind of the big difference, really.
Yeah. So and that's a really good point that you took a look at your skill set and your background and your experience, and it aligned very well with becoming an operator because there was a lot of similarities to what you were doing in your day job, it sounds like, right?
That's right. Especially with the project management side.
Okay.
And then having got a few single families under contract and going through that process, just kind of excited and motivated me. Whoa, what happens if I get a 10 unit or a 50 unit?
Sure.
Multiply that. So,
okay.
Yeah.
So you end up taking down a 12 unit, and that must have been a fairly positive experience because you decided literally to 10X on the next deal.
And by the way, I should mention, Randy, one other key point is I didn't just do it alone. This is a team sport, as you know. So that was key. Even though I didn't have it built up front, I had a great mentor and advisor helping me through the whole thing. So it wasn't like I was just going in alone. Otherwise, I would have been scared shitless as well. So,
okay.
Yeah. Well, I still was scared shitless, but
I'm sure.
But that really got me through, and because they keep you accountable, and they've been through those things before, and all the scary parts, and really help you and guide you through the things that we haven't done.
And so, did you, when you were doing the singles, did you decide like consciously, I'm going to go multifamily, I better go out and get a mentor to help me with these first deals, or did you kind of run into some challenges and make the decision to go out and find somebody then?
I decided I was going to get a mentor. The challenge for me was which one. I had looked at a few. I had been listening to Rod Cleef's podcast for a long time, and I really wanted to go into his program. And it was sort of fortuitous because the person that ended up being my mentor, Jens Nilsson, is Rod Cleef's student, one of his students. And I had listened to that podcast and remembered it. So when I connected with Jens, we have a kind of a common interest in New Mexico, and he found me on Bigger Pockets. And that's where I connected with him, and I said, hey, I saw you on Rod's podcast. I know exactly who you are. And so that just kind of kicked it off because I really liked hearing his story. He came from Denmark and started here, as he was in IT for a lot of years, and then ended up quitting his job and going full-time in multi. It was just a really cool story. And so when I found out he was having a coaching program, I was like, yeah, heck yeah, I'll jump in.
Okay, so you didn't join Rod Cleef's. You actually joined what would ultimately be your partner on those first deals.
Yes, that's right.
Interesting. Okay. Yeah, fantastic. So, and now has he been your partner on subsequent deals as well?
He's been a sponsor on one of our deals in the one in Las Cruces. And then he sort of helps us all out going forward. It's kind of deal by deal. I think he's so busy with his own deals at this point that he's really focused on that and taking care of those. So, but he's helps us all along the way out with our deals that we're looking out now, and he's still my coach and my mentor.
And we've not gone down this path on this podcast yet, but I'm wondering, you mentioned that he became a sponsor on your 123 unit. Can you talk about what some of those roles look like? How do those interactions look? What do the business models look like? For the passive investor, how does that impact them, and what should they be looking for when they run into similar situations?
Yeah, I think it's important to have a sponsor that has a lot of experience, like Jins or a lot. There's a lot of sponsors out there, but they need to have gone through deals full cycle.
Okay.
And been through all those things. And so that was really key for us, having that guidance on our first large deal, going through that.
And then, so what was your role in that Las Cruces deal? If he's the sponsor, do you find the deal, underwrite the deal, do the asset management? What does that look like?
Yeah. So I found the deal. I brought the deal from a local relationship with a broker here in Tucson. Okay. They knew I went to school in Las Cruces. Okay. And so they actually have an office there, and they thought of me when the deal came. And so that's kind of how it started. And then also, so I brought the deal. I helped get it under contract. And then of course I've been involved in the asset management and running the project ever since.
Got it. Okay. So even though he's
construction, everything.
So even though he's the sponsor, you're the one that's really doing a large portion of the work on this deal.
We're doing the work. Yep.
Got it.
And then he guides us in meetings and kind of helps us out.
Okay.
Yeah.
Okay. And I think
especially
that's a really
during the
good
first
point.
year, we needed quite a bit of help, of course, just
I'm sure
through a lot of the process there. But
okay.
My civil engineering background was really key during that year because we had a lot of vacancy, and so we had to go in there and turn those units really fast. And so I can remember I had 8 to 12 contractors, we were turning 8 to 12 units. I had 3 or 4 contractors all going at the same time.
Wow.
And so I was able to get a bunch of those turned really quickly and help turn the project around, which was really key.
Yeah. So that's interesting. And I think for the listener, it's important to note, like, this is what Colby is doing is anything but passive. Like, he's very actively involved. There are a lot of hours that are involved in this. There's definitely significant upside on the back end. But this is, I would say, at best, a part-time job for you. And at worst, more than a full-time job at times, right?
Oh, absolutely. Especially that first year. It's a lot of hands-on and day in and day out. And then, overseeing the property manager as well, weekly meetings and staying on top of them during the week to make sure things are going like we want them to.
I think this is an important conversation for our listeners to hear, because it really kind of gives them a peek into what's going on in the back end with operators like yourself that are partnering with sponsors and literally doing all of the work. And it's a very, very different undertaking than passively investing in a deal. So I want the listener to appreciate all of the work and effort and energy that goes in there. So let's talk about, if we can, asset management a little bit, because, I hear asset management referenced all the time. Like, there's a couple of really, really great books out there on asset management specifically, and some folks that claim to be experts in it. But what is asset management in regards to a value add multifamily deal, Colby? And what are some of the strategies and techniques maybe that you leverage on your properties?
So it's, the biggest thing is being able to manage the manager and oversee kind of the metrics of the property, how the property's doing, how many move-ins are they getting, how long is it taking to turn units, how many work orders are there. You're looking at the whole business side of the operation. What are the costs? How much is it costing to turn those units? How much? And then, of course, the bottom line. What are we actually making at the end of the day, and what are we distributing to our passive investors, which that's obviously the number one goal that we're trying to do. Is at the end of the month we have money to distribute. So all those things, and then of course going to the property, getting in front of the manager, and just making sure you have a really good manager on site that knows what they're doing. Especially what we found is the on-site manager is absolutely key. The regional managers are very important. The company is obviously very important, but who they put in the person in the seat there and the maintenance, that's where the rubber hits the road, and absolutely critical for the success. And it has been for us, absolutely key.
Yeah, and I think that, when I first came into the space, I just assumed that you hire a property manager and the property manager kind of handles all of that. But like property management is the day-to-day management of the asset, but asset management is executing the business plan, which is driving the value that ultimately leads to the returns to your investor. Because if you just buy an apartment and you property manage it for 5 years and you sell it, you're not necessarily adding any value to it, and that's going to impact the return. So asset management seems to be the key to average returns versus outstanding returns, in my experience.
That's right. And it's communicating that to your property manager and making sure that they understand where we're going. Sometimes they really don't care about the language. We found out, like when we start talking distributions and all those things, that's not really their language. It's the metrics. It's the move-ins, the turn time, how many leases are they getting ready, how many applications have they received. Those are the things they understand and that you have to stay on top of day in and day out.
And so I'm curious. I've heard a number of operators that end up transitioning from one property manager to another. I suspect there are property management groups that are very good at like a value add business plan versus a stabilized business plan. Do you see that that's a different type of property manager, or what are your thoughts around that?
Yeah, absolutely. And I think it depends on the class of the property too. Is it C class? Is it B class? The size is critical. The smaller properties, there's different managers for those than the bigger ones. And then when you get into affordable housing, that's a totally different animal. It just goes on and on. It's almost an endless list of types of property management out there. And you got to be real careful with the one you pick for your property. They have to be a really, really good fit. And I think that's one thing that we did really well, was selecting the right property manager for the property we have.
So when you bought it, there was an existing property management group that was probably in there, and did you
Mom
transition?
Yep.
It was, so the person who owned it was managing it? Is that what was going on?
Basically, it was a friend of the owner. Yeah.
Okay. It's probably somebody who's getting free rent and maybe a couple of bucks a month or something, right? Okay.
Yeah. I think they were running an all cash operation with manual ledger books, the old style.
Okay. Okay. Yeah.
Was,
So I'm curious, like, you bring in a new property management. They're probably, I don't know. I'm guessing though that the tenants understand that there's a new sheriff in town, so to speak. Things are going to be run a little bit differently. Is that an uncomfortable transition for the tenants, or did you get any major turns initially out of the gates, or what did that look like?
I don't think it was. I think it was a really welcome change for them. They wanted to know that they were getting their units updated. Some of the deferred maintenance that had been there for years and years and years, that they had, just been really neglected, and they lived there because they had no other place to go. But I think where we really started to see the vacancy was the problems, the crime, the traffic. They knew that they were going to have, that was coming to an end. And so we did start to see a lot of people leave. And of course, we had to force some of them out. And it was tough. It was during COVID. But we were able to use the eviction courts, and they were still functioning, thankfully, through that time. We could get them on a break a lease versus non-payment, which we couldn't get them out for. but usually there was something on the break of lease where they were a problem that they were causing, and we were able to get them out that way. And then some people just naturally, natural attenuation, they left because they knew it was coming. But yeah, that was a huge challenge because it seemed to happen all at once. As of last June, I think we had a huge vacancy. May June kind of time frame.
Yeah, it's interesting. I talk with a number of investors, and they're, the business model that you and I operate in, being value add, is quite often we take over assets, we start renovations as we turn units. Ultimately, we increase rents at that point. And the concern is that operators like you and I are coming in and evicting everybody and raising the rents to a point that people can't afford. And what's going to happen to these people that were living there before? But it sounds like, and what I'm hearing is that there's kind of a bad element tenant that ultimately naturally just kind of ends up leaving. And then the really good tenants, the ones that we really want to take care of, they're the ones that are really, really happy to see that, the playgrounds are getting fixed and the pool looks a little nicer, and they're not afraid because you're really starting to crack down on crime around the apartment. So
Yes.
The tenants we really want to take care of get taken care of, right?
Yes. I mean, we did have a few leave during the time because they were just so sick of dealing with it, the crime and everything that was going on. But overall, you're exactly right. We had some very good ones that stayed. And then, of course, when you get rid of those folks, you're able to bring in better tenants that want to live in a nice, quiet place and not have stabbings or whatever's going on around them.
Yeah, exactly. Well, very cool. So now, fast forward, it's been a year since low occupancy. How's the asset looking? How's it operating? Are your investors happy with how things are going?
I think so. I think it's been a really cool story. We finally saw the light this fall when we were starting to get our occupancy up, and then of course the holidays hit, and then that's a tough time for tenants. So we had it kind of stayed flat for a while, and now we're on the upswing. I think we're over 92% occupancy now. It's cash flowing really well, and we're starting to do more regular distributions at this point, which is really cool. And I should mention we got a great loan on the property, a seller carry note, which absolutely was critical. So we avoided the bridge loan, which we may have gotten had we not got this loan, because it was such a heavy lift and portfolio kind of spread out and no financials. I think a bank would have been hesitant to give any type of loan other than maybe a bridge.
Okay. And I'm curious, so our listeners might not understand what seller carry is and why that would be advantageous. Can you walk us through what that is?
Instead of having a bank own the note or the mortgage for the property, it's actually the seller or the owner has the note. And then so we pay him the mortgage every month. It goes to him directly. And that's advantageous for him because he doesn't get the huge tax hit versus, and he also gets great cash flow off of it. And he's not, of course, operating the property anymore. And for us, we got great terms. It was a win-win all around. At that time, we got a 4% interest rate, which didn't seem that great because they were getting like 3.25, and then they were getting their CapEx. So the capital expenditures were being paid for on a bridge loan. So that sounded very appealing, but at the end of the day, we're so thankful we got that note, which has allowed us to survive, basically. I mean, we would be dead in the water right now if we had a 9% interest rate or something crazy.
Like a lot of operators are experiencing right now, right?
Yes, it's really tough. I feel really bad for those folks. I know it's going to lead to a lot of opportunity, but at the same time, it can't be an easy thing for a lot of the operators that have those loans out there.
Yeah. Yep. Very good. Well, let's shift, if we can, for kind of the last portion here. I want to get your idea and your feel about where the market is, where it's going. You mentioned potentially some opportunity coming up. Where do you see the market today, and where we'll be in the next 6 to 12 months?
So today it's a little discouraging. It's hard to find deals right now. There's just not much out there, especially now with the 4th of July coming up, and it does slow down anyway, but it's just been really slow. A lot of the sellers are still thinking they can get the values of over a year ago, and the buyers are down here because of the interest rates and the leverage that you can get on a property, which is how much they'll pay you for the loan. It's just really low right now. So it's really caused this sort of stalemate where not much is happening. But I do see that starting to ease a little bit over time with some of these loans that are going to be maturing, and especially on the bridge loan side, they're going to have to refinance or sell or something just to make it work. Now I know there's a lot of operators that have a lot of reserves and are doing just fine, but I have heard that, in the industry that's coming, and so there could be some great opportunities on the horizon.
I would agree. I think that we're finding deal flow is certainly lower than I've heard estimates of like 75% decrease in transactions the first portion of this year. It's making those deals that do show up that very, very competitive because everybody's chasing them if it's a good opportunity.
That's right.
But yeah, no, I agree. I think in the coming months and years, there's going to be a ton of opportunity for folks that got bad loans. And at the time, like nobody has hindsight's 2020. Nobody knew what was going to happen with the interest rates. Some people were more fortunate than others to have good loans in place and get rate caps in place to kind of protect them and their investors. So I think the experience shines through. And folks that have been in this space for a long time maybe saw the writing on the wall a little bit more than some of the newer players. And I think ultimately that'll play out in returns as well. So I'm curious, our listener is kind of the newer passive investor, and there are a lot of really, really big players out there that, they're doing 40, 50, 100 deals that they've done in the past. And then there's a group of folks that are just really good, hardworking operators that are smart folks that are trying to present opportunities to their investor base. What do you think is the advantage or the disadvantage of going with a big or a small operator as a passive investor?
Yeah, I think, on the large operator side, you're getting that experience that they've been there before, they've done it. And so you have that assurity that your money's probably going to be safe. Now, I know that's not always the case. I hear a lot of these bigger operators talk about how they're going through some of these challenges right now, but they have such a big portfolio that overall it doesn't really affect them. But there might be some of their deals they're going through with these bridge loans right now where their investors aren't getting paid either. But overall, I think they're doing great. I think, with a more experienced operator, they're probably going to be a little higher on the fee side because they know they can get it. I think with somebody that may be less experienced, that may be an advantage where you can get some more impact on your dollars there, because the operator may not have as high of fees. They may be willing to give more to the passive investors on the split side and the fee side and all those things, especially if they're really a cognizant operator and they're trying to do the right things and help their investors. When we're starting out, we know we can't just put a 5% acquisition fee on there and expect the investors to like that, like a Grant Cardone or something, where he can do that all day long. But
yeah, absolutely. No, I think
but he's done a ton of deals, so that's the other side of it, right?
Yep. Yeah, and you would expect that returns might be there's more baked in cost. A lot of these guys are fully integrated, so there's a lot of fees and revenue that's going to internal businesses as well. Very, very different than working with a group like yourself that has great mentorship, great direction, and experience through the mentorship, and now your own experience as well. I think it's more with smaller operators. There is that personal touch as well, where there's probably more of a personal relationship with the operator than there might be with one of the big guys. You get that kind of just another name or another number on an Excel sheet as a passive investor with the really, really big guys. So I think you bring a ton of value, Colby.
Yeah, it's more interpersonal with our investors, for sure. 'Cause we know them and they know us, and that's the beautiful part of the business is getting to know so many people and learn what their goals are and what they're after and all those things. That's what makes it fun.
I love it. I love it. Well, let's, if we can, shift into kind of the final section of the podcast. I have a couple of questions I'd like to ask everybody. Can you tell the audience or maybe share what you think could be really good education resources for folks to pursue if they're new or newer into the passive investing space?
Gosh, it's so cool. I mean, we're in a time when there's a lot out there. There's so many books and resources and mentors. You can get a coach and guide you through it. Great books like the Passive Investor book from Brian Burke. Great book that I've read and really has helped me in my business to understand better what, how to view passive investors and what they're looking for. But I also think just getting involved in a deal, if you can somehow on the active side, I think would help a ton. I mean, on the job training is huge.
You can read all the books in the world and read all the podcasts, but until you get in the ring, so to speak, you're not going to know what it's like to get punched, right?
Yeah, absolutely. The best education you can have is just being in it and doing it.
Love it.
I think. But
okay.
So many ways. Yeah, it's real cool.
And how can our audience find you or find more about Mountain Bridge Capital?
So you can go to our website, mountainbridgecapital.com, and we've got a free ebook on there, 7 reasons why we love multifamily investing. And I'm on LinkedIn, Facebook, and my email is colby@mountainbridgecapital.com if you want to get a hold of me.
Fantastic. Well, Colby, thank you so much. I appreciate you being on the show and dealing with our technology issues that we've had and being willing to jump on and kind of share your experience and your path to where you are today. I think it's super inspiring from an active standpoint to hear the amazing things you've done in a relatively short amount of time. And just look forward to seeing what you do in the future. Just excited to be sitting on the sidelines watching what you're doing.
Thanks, man. And I've enjoyed meeting you as well and following you and your success. It's been really key for me. Just enjoyed working with you, man.
I appreciate it, Colby. All right. So to our listeners, I would say, as always, we encourage you to continue your education process, learning more and more about passively investing. And more important than that, I strongly encourage you to find an operator that you know, like, and trust. Consider putting even just a small amount of dollars into that first passive investing deal. I'm so confident that once you do, you'll wish you would have done it sooner, and you'll be one step closer to decreasing your dependence on your W-2. So thank you again for listening today, folks, and we'll look forward to next Thursday's episode where we'll have another great guest and more great content for you. Thank you.
Well, there you have it, ladies and gentlemen, another episode of The Gentle Art of Crushing It. It was an amazing episode. We know we sure learned a lot, and we hope you did as well. We want to take a second and thank you so much for viewing or listening to this episode. And please just know that we only ask for one favor, and that is to make this life magnificent. Thank you, and have a wonderful day.